Hold it right there. What you're about to hear could decide the future of your XRP bag, and if you click away too soon, you'll miss the most important critical piece. This is not financial advice. Always do your own research and consult a qualified professional. For context, XRP is around $2.83 at the time of recording. If you're watching this later, the price may have shifted. XRP is consolidating in a tight zone today, and that calm surface is exactly why this moment is so deceptive. Give me 60 seconds and I'll show you how a quiet market flips into an overnight repricing that catches almost everyone off guard. Let's set the stage. The global financial system is carrying stress in places most investors never look. Interest rate differentials, cross-currency funding, and a web of leveraged bets built on the assumption that volatility stays contained. For decades, institutions borrowed cheap yen and redeployed it into higher-yielding assets around the world. That carry trade worked until it didn't. When yields jump or currency spreads snap the wrong way, leverage unwinds, and the unwind is never polite. It is forced, it is fast, and it sells what it can, not what it wants. In that kind of scramble, liquidity vanishes right where you expect it the most. Major bond markets, FX pairs, even blue-chip equities. Stay with me, because in 1 minute we'll connect this directly to XRP's role and why holders could be standing in front of a structural repricing. Think about the scale for a second. We're not talking about a few $billion needing to rebalance. We're talking about layers of exposure that stack into the trillions. When stress hits, institutions rush to close positions, roll funding, and source liquidity. Now, that simultaneous demand for the same exits creates a bottleneck. Prices don't drift, they gap. And when the world gaps, the backbone of the system, the bond market, groans under the pressure. Mortgages, corporate borrowing, government financing, all of it runs through that backbone. So when those pipes clog, you don't just get a red candle, you get a problem with the plumbing. Here's where a lot of people get the story half right. They see the risk and assume the only outcome is a crash across the board. But in every crisis, there's also a race for new rails. Faster, cheaper, neutral settlement that can move value across borders without being hostage to legacy choke points. That's where XRP enters the conversation, not as a meme or a moonshot, but as an answer to a very old problem. How do you move big value, fast, without tying up balance sheets or waiting on correspondent banks? If you hold on for just 60 more seconds, you'll see exactly why this matters to the price on your screen. XRP's design is brutally practical. It's built for throughput. It's built for finality. It's built to bridge currencies without requiring pre-funded accounts sitting idle around the world. In a low volatility world, that advantage is interesting. In a high volatility world, it's essential. When spreads blow out and traditional liquidity sours, the market hunts for settlement that is both immediate and capital efficient. The question isn't, is blockchain cool? The question is, what clears right now without tying up my cash? That is where a bridge asset can move from optional to necessary. Meanwhile, macro fragility is stacking. Japan's policy shifts ripple through FX like shockwaves. Oil spikes when the yen weakens, squeezing importers and forcing tough choices on central banks. In the West, growth and inflation push and pull policy toward a narrow path, and every basis point surprise turns into a stampede across rates and currencies. It only takes one misstep, one unexpected hike, one messy auction, one liquidity hole, to reveal how shallow the lake really is beneath the glossy surface of the order books. When that happens, everyone reaches for the same lifeboats at the same time. Let's talk about the suspense you can feel but can't quite name. On-chain, you see quiet accumulation. Exchange balances drift lower over months, sometimes years. It doesn't trend on social feeds, but it matters. The circulating supply that is actually available at the click of a button keeps shrinking. Custodians lock inventory for institutions that don't trade on headlines. They plan quarters ahead. Then one day, a catalyst hits. Policy, legal clarity, a major corridor lighting up, and the visible float simply isn't there. Prices don't move in a straight line under those conditions. They jump to where the next real liquidity sits, and sometimes that's dollars higher in a single step. Don't click away yet. The real shocker is just around the corner. Here's the shocker. The system doesn't need a million new buyers to reprice XRP. It needs a short window where utility demand and inventory realities collide. Think of it this way. If settlement corridors begin to push real volume, while ETFs or institutional products demand guaranteed supply at the same time, exchanges will discover how little is truly available. That discovery process is not gentle. It's a repricing event. The move doesn't announce itself. It appears as a gap on your chart with no trades in between, and by the time your alert goes off, the level you wanted is gone. This is exactly why timestamps matter in videos like this. At the time of recording, XRP is around 283. If you're watching later, the number you see might be higher or lower, but the logic holds. Thin tradable float plus sudden structural demand equals discontinuous price. And that's before we even layer in the macro need for speed when legacy rails are jammed. Listen carefully because what I'm about to share flips the mindset most holders carry. It's not just about number go up, it's about can the system clear? When clearing speed and capital efficiency become survival tools, assets designed for bridging don't just participate, they lead. You don't have to believe in wild targets to see this. All you need to recognize is how markets behave under stress. They reprice first, explain later. Watch any historic liquidity squeeze and you'll see the same movie. Complacency, crack, scramble, gap, narrative. We are in the complacency chapter right now. Volatility is quiet. Headlines feel repetitive. That's how lulled markets always look before the plot twists. Give me one more minute and I'll map how unwind mechanics actually play out so you can see why gaps, not arcs, tend to define the big moments. Before we move on, lock in 3 truths. First, liquidity is not the number of tokens printed. It's the amount truly for sale at each price level. Second, institutions prepare during boredom and deploy during chaos. Retail does the reverse. Third, bridge assets don't need perfect sentiment to re-rate. They need utility to collide with scarcity. Put those together and the path is obvious. A calm tape, a fast catalyst, and a repricing that seems impossible until it's already printed. Stay with me because in the next section, I'll break down the unwind step by step. What sells first, how FX flows back through the system, why bond markets set the tempo, and exactly where a bridge asset can absorb the shock. If you hold XRP, the mechanics are everything. Miss them and you'll miss the moment. Now let's break down exactly how the unwind works, step by step, because if you don't understand the mechanics, you'll never see the setup forming in real time. Stay with me, because in the next 60 seconds, I'm going to show you why liquidity events don't move like a gentle tide. They rip like a riptide and leave almost no time to react. This is where most retail gets caught flat-footed, thinking they'll have days or weeks to adjust. In reality, the shift can be visible in hours. Start with leverage. The global financial system is stacked on layers of it. Fund managers, hedge funds, banks, even corporates with swap lines. They borrow short, lend long, roll over constantly. As long as conditions are stable, everyone feels brilliant. But when rates rise or currency spreads snap, the whole house shakes. The first thing to go is not stocks or crypto, it's bonds. Bonds set the risk-free curve, and when they wobble, every valuation model in the world recalculates. That recalculation creates selling, which cascades into FX, then equities. Think of it like dominoes. The bond market tips, FX scrambles to adjust, and stocks are forced to reprice on the fly. Now imagine trillions of dollars in carry trades unwinding at once. Japanese investors suddenly face losses as yields shift. European banks scramble to plug gaps. U.S. institutions start dumping assets to cover currency hedges. It's not coordinated, it's chaos. And in that chaos, what everyone is desperate for is liquidity that doesn't evaporate under stress. Here's the irony. The very places they expect to find it, treasuries, major currency pairs, even gold futures, are the ones under the heaviest strain. That's when alternative rails go from curiosity to necessity. Enter XRP's potential role. Remember, this isn't about speculation, it's about function. When markets jam, you need to settle quickly across borders without pre-funded accounts, without waiting on slow correspondent banking systems. XRP is tailor-made for that niche. But the market doesn't care about tech demos. It cares about what clears in the heat of battle. If SBI in Japan, for example, can route settlement through digital yen channels backed by XRP liquidity pools, you suddenly have an option that is faster, cheaper, and immune to clogged traditional pipelines. In 1 minute, I'll show you how that plays directly into price repricing mechanics. Think about the Bank of Japan for a second. For years, they've been the silent anchor of the global carry trade, keeping rates pinned while the world borrowed yen to redeploy abroad. If they blink, if they let yields rise or currency policy shift, the chain reaction hits everywhere at once. Corporations need to hedge exposure, funds need to close trades, banks need to rebalance books. The demand for settlement explodes. XRP doesn't have to replace every system to matter. It only has to absorb a fraction at the right time. That fraction, layered on top of already thin exchange balances, is enough to move the price vertically, not horizontally. Let's connect this to something tangible. Picture a bond fund dumping treasuries because collateral calls are hitting. They raise dollars, but they also need to square currency risk in Japan or Europe. Normally, they'd go through FX desks, but spreads are blown out and liquidity is terrible, so they look for alternatives. A corridor using digital yen and XRP suddenly looks attractive. The execution is immediate, the cost predictable. Now scale that out across multiple players under pressure. The flow builds on itself. Demand for bridge liquidity accelerates. Prices don't crawl, they sprint. Don't click away yet. The single most important trigger is coming up. Here's the trigger. ETFs and structured products waiting in the wings. These vehicles cannot operate in chaos unless there is clarity and liquidity. The moment regulatory clarity hits, and it always does eventually, those products demand supply. Not retail trickles, not exchange scraps, institutional size supply. Where do they source it? Custodians and the open market. But the open market float is a puddle. That's when the repricing event is forced. Imagine an ETF needing hundreds of millions in XRP units overnight. That's not a buy wall. That's a vacuum-sucking supply up the ladder of order books until a new equilibrium is found. The psychology is brutal. Retail traders expect to see warning signs, rising volumes, gradual price climbs, clear signals to enter. But in systemic liquidity events, those signals don't come until after the repricing has already happened. One day you're staring at $3 XRP. The next print is $7 with nothing in between. That's what gaps look like. And that's why holders who understand mechanics don't try to time it. They position before. Because once the gap is visible, the opportunity is gone. Give me one more minute and I'll connect this directly to how ETFs, banks, and digital currency pilots all collide at once. Now layer in global coordination. Central banks aren't blind. They know liquidity crises are inevitable in leveraged systems. That's why they prepare backstops, swap lines, and increasingly pilots with blockchain settlement. The BOJ, the ECB, the Fed, all exploring digital currency rails. If those rails use XRP liquidity pools even indirectly, then the moment stress arrives, volume floods in. Utility is not a meme. It's the hidden bid under the market that retail never sees coming until the tape jumps. This is where the retention spike hits. Listen carefully, because what I'm about to share flips everything upside down. Most people believe XRP's future price depends on hype, retail adoption, or speculation. But the actual driver is institutional necessity during liquidity stress. That's when it graduates from crypto to infrastructure. And when assets graduate, they don't move in percentages, they move in multiples. The repricing is violent because it has to be. The system cannot function unless the bridge asset's price matches the value it needs to carry. That's the essence of structural revaluation. So here's your takeaway from Section 2. Liquidity events don't unfold neatly. They cascade. Bonds wobble, FX surges, equities sell off, and hidden in that mess is the desperate need for fast, neutral settlement. XRP is uniquely positioned to serve that role. If it does, even partially, the demand collides with shrinking supply, and the result is a repricing event that doesn't wait for consensus. By the time headlines catch up, it's already history. Stay with me, because in Section 3 we'll dive into the reality of shrinking exchange supply, ETFs hoovering up liquidity, and why the order books you see today are an illusion. That's where the shallow lake analogy comes in, and it will change how you think about every chart you look at. Liquidity is often imagined as an endless ocean, but the truth is far closer to a shallow lake. It looks vast on the surface, it reflects the sky, and it tricks you into believing there's depth. But the moment a drought hits, the rocks appear, and what seemed infinite is revealed as fragile. That's exactly where XRP stands today. On-chain data shows it clearly. Exchange balances have been bleeding out for years, wallets tied to institutions, custodians, and even long-term retail holders have been pulling supply into cold storage. Once those tokens leave the visible float, they almost never come back. Yet if you look at an order book on your favorite exchange, you'd think liquidity is deep. That's the illusion of the shallow lake. Now let's layer in the ETFs. These products don't nibble, they feast. When an ETF is launched, it requires guaranteed supply on demand. It cannot risk being unable to fill creation orders for shares. That means custodians must pre-secure huge pools of XRP, not for speculation, but for function. And when they secure it, it's not sitting back on the exchange waiting for you to buy. It's locked, custodied, and often wrapped inside regulatory structures. The drain is invisible until the moment it collides with demand. At that point, the shallow lake reveals itself, and the repricing begins. Picture this: XRP hovering in a calm range, order books looking stable. Then a floodgate opens. An ETF provider needs hundreds of millions in supply in a single week. They go to custodians, but custodians have already secured much of their holdings. The remainder has to be sourced from the open market. That's when the order book gaps. You don't move gradually from $3 to $3.20 to $3.40. You jump. One tick is $3, the next available fill is $4.50, maybe $5. Gaps don't care about your limit orders. They skip levels entirely, repricing in chunks because the float is that thin. This is where psychology enters the picture. Retail investors believe they'll see the move forming. They think they'll recognize the momentum and jump in at a reasonable level, but history shows that's exactly how they get trapped. The move doesn't unfold like a rising tide. It erupts like a geyser. By the time the average trader sees it, the price is already multiples higher. Panic buying sets in, followed by engineered pullbacks to shake weak hands. This cycle repeats until the majority are churned out of their positions. Meanwhile, the actual winners are the ones who already held during the boring, frustrating, stagnant phases. They endured when it was least comfortable, and when the gaps came, they didn't need to chase. They were already in position. Let's break down the phases of XRP's potential revaluation so you can see the bigger picture. Phase 1 is the liquidity crunch. This is the most violent and chaotic stage. It's when the shallow lake is exposed and prices gap higher in rapid bursts. Headlines scream. Social media fills with disbelief. People argue over whether it's sustainable, whether it's manipulation, whether it's real. The market overshoots, retraces, and shakes out weak hands. The point of Phase 1 is not stability, it's exposure. It forces participants to realize that the supply they thought existed simply doesn't. Phase 2 is utility scaling. This is when XRP becomes unrecognizable to the average retail eye. Instead of volatility driven by hype, the baseline demand comes from necessity. Banks, payment providers, and corporate treasuries begin pushing real volume through corridors because it works. These transactions aren't speculative. They don't care about chart patterns, influencer predictions, or fear and greed. They just execute, day after day, hour after hour. That baseline demand creates a relentless bid under the market. Now combine that with speculative inflows from ETFs. You end up with a dual-engine dynamic. Speculative demand on top, utility-driven demand underneath. One engine alone is powerful. Together, they're exponential. Phase 3 is institutional dominance. This is the phase where the float consolidates, not across millions of small wallets, but in the hands of a concentrated few custodians, funds, and institutions. Retail thinks they're holding the prize, but by this point, most have been shaken out during the chaos of earlier stages. Those who remain hold life-changing positions, but they also face life-changing temptations. The historical pattern is clear. This is where fortunes are either cemented or squandered. Many sell too early, handing supply right back to the institutions who engineered the move. The few who hold with clarity and conviction are the ones who live to see the full scale of the transition. Here's the part you can't afford to miss. Stay with me because the next 60 seconds matter more than everything before. The shallow lake analogy isn't just a clever metaphor. It's the truth of how markets function under stress. Liquidity is perception until it isn't. Once the curtain is pulled back, it doesn't slowly close again. It's ripped off permanently. When that happens, there's no polite warning, no flashing light that tells you to buy. The repricing is abrupt, and it never revisits the levels you see today. At the time of recording, XRP is trading around 2.83s. If you're watching this later, the price may have shifted, but the principle hasn't changed. The shallow lake is still draining, ETFs are still preparing, and institutions are still consolidating. The trigger could happen at any time, and once it does, the debate won't be about whether XRP can hit $5 or $10. That will be old news. The conversation will shift to whether it can handle trillions in daily flows at hundreds or thousands per token. All right, you've made it this far, and now we step into the final section. Everything we've covered, the unwinding mechanics, the shallow lake, the phases of revaluation, comes together here. This is where we compare XRP's position to the other giants, look at the macro backdrop, and understand why the endgame isn't about speculation at all. It's about structural necessity. Stay with me because in the next few minutes, you're going to see why the calm you feel right now is not comfort. It's the silence before the storm. Let's start with the comparison everyone makes. XRP versus Bitcoin and Ethereum. Bitcoin is the undisputed brand of crypto. It's the digital gold, the headline magnet, the first mover. But Bitcoin is not designed for speed, settlement, or scale. Its network processes transactions slowly, fees can spike, and the system itself is intentionally limited. Ethereum, meanwhile, is the king of smart contracts. It birthed DeFi, NFTs, and an entire ecosystem. But Ethereum's settlement times, gas fees, and reliance on Layer 2s make it complex and often unreliable for global-scale payments. Both assets are important in their own right, but neither is purpose-built for the exact role that XRP fills, the universal bridge for liquidity. Now here's the critical distinction. Bitcoin and Ethereum trade almost entirely on speculation. Their price action is driven by narratives, halving cycles, institutional flows, and retail sentiment. XRP, on the other hand, is tethered to utility. Its design, its partnerships, its integrations all point toward function, not hype. And that's why its revaluation, when it happens, will look completely different. It won't be a bubble inflating and popping. It will be a reset, a repricing to align with its role. Think of it this way. Bitcoin goes up because people want it. XRP goes up because the system needs it. That's a gulf wider than most realize. Let's zoom out to the macro backdrop. Rate cuts are on the horizon. After years of tightening, central banks are finally signaling the pivot. Liquidity cycles always follow the same rhythm: stress, pause, easing. And every easing cycle in history has created massive asset repricing. Stocks surge, commodities rally, risk-on trades ignite. Now add the context of tokenization. Trillions in assets, from bonds to real estate to commodities, are moving on to blockchains. That shift requires neutral settlement layers, and XRP is already in position. Rate cuts provide the liquidity. Tokenization provides the flow. Together, they create the perfect environment for XRP's repricing. Historical bull markets give us the playbook. Every major liquidity cycle produces an asset that leads the charge. In 2009, it was tech equities. In 2017, it was Bitcoin. In 2021, it was Ethereum and DeFi tokens. The next cycle will not crown another meme coin. It will reward infrastructure. And XRP, by every metric, is positioned as infrastructure. That's why the conversation isn't about whether it can climb to $5, $10, or even $50. Those numbers are stepping stones, not destinations. The destination is structural alignment with global liquidity flows. That's not measured in tens of billions. It's measured in trillions. Here's where psychology comes in, and it's perhaps the most important part of this entire journey. Most people will miss it, not because they don't understand the tech, but because they can't endure the discomfort. They'll sell too early. They'll doubt when the price stalls. They'll panic when engineered pullbacks shake the market. They'll convince themselves it was all hype right before the real move begins. That's how wealth transfers are engineered. The few who hold through boredom, disbelief, and fear are the ones who capture the revaluation. Everyone else watches from the sidelines, regretting not just the missed gains, but the lack of conviction. Let's paint the vision of the future, because this is where it all comes together. Imagine a financial system where banks use XRP daily, not as an experiment, but as standard practice. Picture ETFs holding billions in XRP units, wrapped inside regulatory structures, off the retail market for good. Envision cross-border transactions flowing instantly, corporate treasuries rebalancing with digital liquidity, and tokenized assets settling seamlessly through neutral rails. In that world, XRP is not a crypto. It's plumbing. It's the infrastructure beneath the system, and its price reflects that role. Not speculation, not hype, but necessity. Stay with me for just one more minute, because this is the ultimate reveal. The silence you feel right now, the sideways charts, the stagnant volumes, this is not safety. It's the eye of the storm. The system is already shifting. NDAs are signed, pilots are running, tokenization frameworks are being built, the pipes are being laid behind the scenes. And when the switch flips, it won't be gradual. It will be instant. Prices will leap, the old levels will vanish, and the new reality will be cemented. The question is simple. Will you already be holding when it happens, or will you be chasing after the fact? Because make no mistake, the calm now is the silence before the storm. The repricing is not a matter of if, it's a matter of when. And when it hits, those who understood the mechanics, the shallow lake, the phases, and the psychology will not be surprised. They'll be prepared. Everyone else will be left asking the same haunting question: why didn't I hold? Remember, this isn't financial advice. Always do your own research. But if you want to stay ahead of the biggest reset of our lifetime, make sure you're subscribed right here. The silence before the storm won't last long. Don't miss what happens next. like, comment, and subscribe for more content.